Alright guys, glad to have you on board again today. We're Wednesday and we're going to give it an update to the flow sequencing and all sorts of stuff. Even though today is going to be a bit particular because most of what is happening here is totally in line with what we said in the previous iteration. And frankly speaking, nothing has changed. We just had new data points suggesting all the assumptions that I shared back then were true. So we're going to summarize all of them and we're going to try expanding into uncharted territory because I've seen some rough speculation, most specifically around the French community in here, and there are some things that have started to raise my eyebrows. So I would just like to set things straight. We're going to fall down the rabbit hole of a bit more speculative stuff using flow sequencing to try figuring out what's the next probable stuff. Because I will set this very clearly as an introductory statement. I clearly told you not to do this, okay? Remember, the flow sequencing is supposed to be among the dumb type trading inside bigger time frame ranges and so on, which means, well, you shouldn't overthink things. You should really make it easy on you guys. You have a clear set of rules and you should follow them as it is. And if the rules are not met, you don't trade, you don't try to forecast where the market is going using the flow sequencing. But if you really want to do this, to me, it's just like, yeah, you would try to go off-road in skiing or whatever, and well, some people might really want to enjoy that. So my job today is to tell you, we're going to summarize all there is to know regarding the flow sequencing around different asset classes, and we're going to try diving into the speculative territory to let you know what you would want to do this, because I've seen some people seriously breaking many rules down the line trying to answer this question of where is the market headed by using flow sequencing, even though, like I just said right before, you should not do it. If you intend to do it, that's certainly not certified by myself as a risk management strategy, okay? The strategy as I teach it to you is and has been battle tested for years by hundreds of people who can attest for its viability and the positive reward expectation there is out of it. Now, if you want to extend beyond the rules and break the limitations that I clearly expressed, surely you can do it. I mean, off-road experimentations are pretty damn fine and exciting, but they're more dangerous as well. So the reason why I wanted to share this today, and even though I tell you not to break the rules, I'll break them in front of you today, just to show you that if you want to go outside the road, surely you can, but just make sure you're well equipped to do this. So I intend, for those who attempt to do it, to tell you that you need to be, first rule, experienced. That means you really need to master the rules and make sure you break none of them, first of all. And if you really want to go off-road, of course, that's possible, but reduce the risk significantly. Just like any regular skier would go using a helmet, an avalanche kind of protection gear and stuff like that. This is exactly the kind of approach you want to have if you go off-road in the markets, okay? If you want to go there, it's exciting, that's great, but please make yourself a safe person if you intend to do this, all right? I'll show you how to do it today. Just a one-time thing, okay? Remember, I don't want you guys to do this. It's fun to go off-road, but most of the actual rewards are in the road. Just follow it. And when the road is boring and straight, just let it play out. Let the time pass, and sooner or later, you'll get some more interesting stuff, okay? So we've mentioned it last week. There's nothing interesting in the market for now. If you try to make it interesting because you're just too impatient, that's your own business, all right? Okay, now back to the charts. Okay, so S&P 500, what did we left each other with the last time around? We told that for those who've been trading the third and final flow, remember that's the third, though that's the final one, you want to get the hell out of here. That means when we reach out the third range boundary, get the hell out of here. So you had a bearish third range boundary signal in here. You could have taken profit there. Otherwise, you had nice third range boundary neutral opportunities here and there, loads of signals, targets of breakouts. You need to be out of this. If you were trading this flow, the third range boundary definitely expressed itself. Get the fuck out of here. That means taking your profits is now mandatory, and it should have been done by now. Okay, that means if you were a bull, you're out. Now, we've also mentioned that if you're attempting to trade this third range boundary to the downside, you need to be very cautious because there is a clear rule that some of you may want to break, but you shouldn't, is that you should never trade the third range boundary when you have a squeeze on the higher time frame, which is exactly what we have. So you can't trade this third range boundary. It's too dangerous. That means in these cases, and we've mentioned that very clearly last time around, is that the probabilities to see the market squeezing its way out of there and making new highs is quite significant. What you also know is that squeezing a third range boundary needs to go at least above the higher time frame context. So now if we want to squeeze that third range boundary, the minimum to go to is 53.80. Okay? So that's basically what you have in here. We need to go at least above 53.80, and if the market goes there, you know the third range boundary has been squeezed. Two things can be done out of this. Remember, when you have a squeezed third range boundary, either you're going to let it create another one, which means the market will retrace, break the context again, and another third range boundary will follow afterwards. And if this one isn't preceded by a squeeze, which likely won't be the case, you can trade that one. So if you want to trade a third range boundary, the current option is to either let it happen without you, which means the third range boundary is there, you just can't trade it. That doesn't mean it won't succeed. It can very well do it. That just means you don't want to take the risk. And if you do take that risk, minimal exposition to the market, because you're clearly breaking a rule there, all right? If you're not, and if you let the market ride in, most likely scenario is it could go higher. And if it does, well, you're going to wait for the next retracement to position yourself into the forthcoming third range boundary, which will offer much better risk limitation than the one we're currently experiencing. All right? So that's the way to go. If you really want to sell the third range boundary, there's no way for you to do it there. If you really want to do it, you're breaking the rules, so make sure you're well equipped and you clearly reduce the risk you take. Could be a fun ride, but you don't want to break the rules. You really want to acknowledge that whenever you do break one rule, should still be okay. Going off-road doesn't mean you're going to die. It just means you can't use that durably with a nice risk limitation. This is not where the safest gains are. So you're getting into riskier territory, reduce the fucking risk and the position sizing. That's what I mean. That means if you're taking a 2% position risk on capital for this, just doesn't make any sense to me. If you really want to go in with a 0.5% risk, I would tend to say, yeah, okay, go ahead with that. No more than that. If you want to experience in the wild ride, fine, but just make sure you're safeguarding your capital. All right? So that's really how it goes for the S&P 500, okay? Not trading to the downside because you don't have the clear rule set to do so. That doesn't mean it won't happen, just means you can't take part of it. What we know in the flow sequence is that as this is the third flow, okay, remember the flow sequencing means now and for on, if we terminated this thing, we're going to have to let the market ride for 2 sets of consecutive flows, which means the context, okay, context needs to be outside the average. The bearish context, the resistant context needs to fall below a flat or bearish moving average. The moving average just can't be rising. It needs to be either flat or bearish, okay? That's in the rule set. Now, that means the third flow, if it terminates in here in a double top pattern or whatever, and so long as it doesn't squeeze out, the next move is to get a bearish flow. That means we want to see this bearish context, the gray boxes, reversing and falling below a flat or slightly falling moving average. And that would be check for the first flow. Remember, that means we have done this, okay? Once we have done this, the market needs to rebound, okay, and break the previous bottom in that case, okay? So that means that's what it is. We need to make a third range boundary afterwards to the upside, which can be broken sometime, okay? That doesn't mean the market has to rebound. It can be broken, but we need to break through the previous bottom, create the second bearish flow, and once this is done, we can start another set of 3 flows to the upside, okay? So that's just the way it goes. If you want to apply the rule strategy in here of flow sequencing in this context, that's all there is for you to know. Either you let the market ride higher and you wait for a third range boundary, and this is something you will be able to trade with safe guidelines, Otherwise, you let the market do whatever it does in here, you don't try to counter trend trade, and you wait for the first flow to happen. To have this first flow happened, you need to see the resistant context falling below a flat or falling moving average. And that's it. Once you have that, you can check your first flow. That means you wait for a retracement and you get to trade the second flow eventually. Or you just let it happen, you don't try to sell, and once you have the two flows visible on the charts, breaking the previous low point and all sorts of stuff, this is where the market will go for the first flow, and you're going to wait for a retracement to trade the second. That's the safest thing to do. Not trying to trade this area, wait for the whole fucking sequence to play its game, and wait for the safest trade to go by. Alright? Don't try to trade all the swings. That's really the key motive in here. I see some of you guys trying to use rules and breaking many of them to just try to forecast what the next move is. Clearly, the rule set you have in here says you shouldn't do anything, which means you shouldn't even bother thinking about where the market's headed next. You should be just like, okay, I don't have any evidence of either upside or downside risk now. All I know is that we're very likely going to jiggle around this area for quite some time, and the next interesting trade is far away in the distance, and therefore the only rational answer you should get down to is, I shouldn't pay attention. I shouldn't give a fuck. Now, if you really want to get into trading anyway, by squishing and squeezing some rules, surely you can do it, but make sure you're well equipped. Reduce the risks to a maximum 0.5% taking. Okay? And that's really the way to go. That means you divide your risk by 4, and if you want to go off-road experimenting in the wild, go fun. Okay, go have fun. I have no problems with that, but just make sure you're safe enough. All right, so that's for the S&P 500. Regarding silver, very quickly in here, nothing has changed. In the weekly chart, we're accumulating below that target. Remember that the previous flow has clearly broken through that target very easily, so I think we're going to do the same. It's just a matter of time. But just understand as well that you need to get ready to eventually not having anything delivered to you until September 2024. So just don't be excited and you want things to be delivered quickly and so on. It could happen quickly or way longer than that. Just don't try to time the market. All you know is that you can't put your stops at break even until you get above $30. Once we do this, we can't put our stops at break even safely and let ourselves ride. That doesn't mean profit taking prematurely for whatever reason, like you feel the market is going to reverse or whatever. All you know is that the market top is impossible for you to figure out. Where you're going to take your profits is going to be the following third range boundary. So get yourself into accepting these kinds of things. The market will move higher and it will always give you a third range boundary to get out of this. So just let it play out. And if you really want to say, okay, I'm not going to wait for another year to get the third range boundary, well, I can understand that. The cost of capital can enter into the equation in here. So if you really want to take your profits, give yourself some targets, okay? Some levels in which you're going to take some profits. Like just personally, I would take some profits at and around 34 based on the signals that I will get. If I get strong bearish signal, I eventually take slightly more profits than expected. If I have no signals, I may take none at all. It's really the way to go. If I have some selling signal in the 43 area or so, I will take some profits as well, okay? So that's how it is. Put yourself some areas in which you're going to work with. If you really want to trigger profit taking in the wild, that's doable, but partial profit taking means you can't get the hell out of here entirely just based on assumptions. But partial profit taking, of course, that's possible. Somewhere around 5–10%, surely you can. Taking profits is always good. But the thing is, well, if you're getting the hell out of here prematurely because you fear the market is going to trap you in or out or whatever, that doesn't make any rational sense. You know that the rule sets I share with you tell you explicitly not to do such a thing. If you decide to do it anyway, I'm not responsible for the outcomes. All it says that the market explodes for whatever reason and you're out of this because you profit taken prematurely, don't come cry to me. Okay? That's all there is to know. Now, if we finish up with the cryptocurrencies, that's the same story. In terms of psychological management, I see a hell of a lot of mistakes. In here, remember the flow sequencing we had is in the 4-hour reference. And if we look at it, we terminated a second flow, which has been overly extended. We've squeezed the third range boundary and all sorts of stuff. Regarding Bitcoin, we've also said that there is a clear, evident Wyckoff pattern in here, which looks a hell of a lot more like reaccumulation than any other thing. Remember, the reaccumulation, made an entire video regarding Wyckoff, and there are all the ingredients for this to happen. We would have done the spring, and we would be headed in the final phases, meaning C, D, and E, which are the late stage maturity for the pattern, headed back to the top of the range and breaking out of this. If the Wyckoff pattern truly is at play, first of all, you don't want to trade it, you just want to acknowledge what it means. It means that something's happening in the wider time frames, and there is a lack of liquidity, so the market is somewhat reaccumulating. And in here, that means the future is this and breaking out of this range, making new highs. That means in this context, we've terminated the flow sequence. Remember, we had the third range boundary, so if you've traded the second flow, you got the hell out of here already. And from now on, you are waiting for one and only one thing. Following the second flow, you know what's next to come in your sequence. You need to get your third range boundary with your profit take, okay? Then you need to wait for the lower Bollinger Band, okay? So that's really clearly the next stage for you is to wait for that damn Bollinger Band to get there. That means this is where you buy Bitcoin today, at 37K. We're damn far away from this, but we could still experience that. I mean, whatever happened, a crash or whatever, could lead us down there, and if we get down there, you might want to buy eyes closed. This is where you would have the nicest, lowest risk opportunity for a third flow, okay? So this is where you wait to buy. On the contrary, if you want to break the rules and to say, okay, I know what I should be doing, but I want to figure out what the market is going to do now, okay? Well, though we know that one probability is that it crashes all over, goes down there, and we're good to go for a nice buying entry. Okay, pretty safe trade. This one you know, go trade it blindly if it happens, okay? What we know then is that, well, Wyckoff pattern says we're going to break it to the higher. We're going to make new highs. Though if we make new highs, that means the second flow is extending itself higher. Does that mean you want to trade it? Nope. You had the signals to profit take, you profit took, you're out of the trade, the flow can extend, you might not want to be part of it. It can go higher, make new highs, and just like we stated for the S&P 500, that's none of your business. You just can't trade that part of the market, just let it play out. It's a new top, which means a third range boundary will follow through. You can't profit take in there because you already did it, and you're just going to wait for what? For the goddamn third range boundary, the goddamn Bollinger Band to get out there. And that means we could very well trade similar prices in the distance, multiple months away from now, because to get the Bollinger Band up here is going to take some time. And in that flow sequence, one out of many other possibilities that could happen in the meantime, this is one you can trade. So remember that. Regarding Bitcoin, you're out of the flow sequence. A lot of things can happen, and you can look for external data points, like using the Wyckoff pattern that says we probably haven't yet made the market top. That just means one thing. If it goes higher, you shouldn't try to take profits out of this because it doesn't make any sense to you. It's not part of the flow sequencing. You might be using external kind of strategies, but it's seriously going off-road. All right? Wait for the market top to build itself. Don't really care about where or when. Just know that a third range boundary will come out, and it should lead us to retrace down to the lower Bollinger Band sooner or later in the distance. When it happens, this is where you want to take your safe buy. All right? In the current, present time, this buying opportunity stands at 40K and below, which seems like pretty damn not probable. Very improbable. So, in my humble opinion, yeah, I think going all-time high is reasonable. That doesn't mean we're going to surge like crazy. It just means, yeah, we go all-time highs. I don't mind how high we go. It's just, yeah, probabilities to rebound out of this are kind of significant when I look at Bitcoin's reaccumulation pattern, okay? That means the second flow might extend further, and you might not want to trade it anyway. All you need to know is to wait until we get the lower Bollinger Band to safe trade it, all right? When it comes to Ethereum, the picture is slightly different. Same story in here. We got the second flow, pretty wild to the upside, pretty extended. We had the following third range boundary, so same story. You have profit taken in here. You're out of the flow, you're taking your nice gains and moving on. You're waiting for the lower Bollinger Band to buy. It's currently standing at $2,000. So if for whatever reason we're crashing out the fuck out of there, buy eyes closed. All right. What are the possibilities for this to happen? That would mean an immediate surge to the downside of 30%. That would be a significant correction out of the recent market top of 50%. History told it's happened in the past, could happen. So know that it's possible. Now, if it happens, really, you want to be buying this. Okay? The second thing we need to understand is that, well, if we jiggle around and go off-road, we would tend to say, yeah, Bitcoin says it's probably going to go all-time high. Are we really going to have a 30% drop of Ethereum in the same time? Doesn't really make that much sense. We could have the same story, meaning we build a range. We don't necessarily retrace where you guys can buy. We can break the third range boundary, make new highs, and then we'll build another third range boundary, and so on. Pretty much the same as Bitcoin. We could get to this lower Bollinger Band late stage summer, or I don't know, somewhere in the distance, okay? All that is to know is that for you, if the market goes higher, it's not part of the sequence you can trade. It just means the second flow after ranging has somewhat exhausted the bears and we go find some more higher. Okay? That's just the way to go. If there are no bears and if we can't stay in here, going all-time high is a possibility. The other option for Ethereum is, well, it doesn't. It rejects the third range boundary and it just extends the range. Remember, ranges can have much more than 4 boundaries. For now, we're at 4 range boundaries. We can do any other thing. We can do like 5th, 6th, 7, 8, whatever, just waiting for the goddamn third range boundary to happen. If Ethereum makes a new high, then the sequence starts all over again. That means a new range is going to have to be built until we get a third range boundary and a retracement to the Bollinger Band. All right? Remember, the flow sequence requires that damn third range boundary to happen. If we make new high, we need to make a third range boundary back all over again. And then we need to retrace to the Bollinger Band. And only when you have that sequence of event, you can buy. All right? In the meantime, if you're trying to figure out what the market is going to do, is it going to do this or that or whatever, it doesn't make any sense. All right? It's not part of the plan. It's seriously going off-road. Whatever it is that you do in here, make it very low risk. Maximum 0.5% risk exposition. Okay? Really, really, I want you guys to understand that. But the final question, the one that I'm pretty damn sure all of you guys have in the back of your heads is, yeah, what if? Though, if Bitcoin does this and if Ethereum goes all-time highs as well, what happens with the altcoins? Well, surely this is where you might be very interested. Because, of course, if there is a bearish exhaustion out of rising moving averages in here, that's the sign generally that we're going to go back up in here and probably make new highs, both on Ethereum and both on Bitcoin. Is Ethereum going to overperform Bitcoin this time around or not? I goddamn don't know. All I say is that we'll see. The market will give the answer, and there's no way we can use technicals to forecast that. All I know is that Ethereum has a very solid risk area to get through at 3,600 because that's where the previous third range boundaries are. This is where currently standing is another range boundary, a dumb boundary, okay? If you're dumb trading this range, this is where you might want to sell it. So I know there is a tough area for Ethereum around 3,750. Okay, we can definitely scroll and fuck it all up through it. Remember that Ethereum's fundamentals are solid like crazy. Though we'll see, but the fundamentals will play out. And this is not something you can predict. This is what the market will do no matter what your technical structure says. But the technical structure says there is a risk area there, and if you want to sell ETH, this is where you want to be doing it. All right? If you want to buy it, currently that's 20,000. All right? That's just the way it goes. Okay? So be very cautious with that. Though the rest, let's assume Atom. All right, because I know that's the one you all guys, you are all thinking of. Okay, so currently, if you're looking at Atom and you want to figure out a flow sequence, you need to be on a monthly support. Remember, you need to be 3 time frames above the flow sequence. Okay, clearly we are. We're in a big monthly support, so okay to do 4-hour sequencing. Yeah, what the fuck is that? I mean, whoa, whoa, whoa. It clearly doesn't look like there's a flow in here. It's really fucking rangy. So, remember that. Zoom out, and you'll get the answer of it. What the heck is that? Yeah, Wyckoff again. We know that one. So it's really the way it goes. We have a huge Wyckoff pattern in here at play in Atom, which means, well, good luck trying to sequence a flow in chaos. So that's the reason why you're all having troubles figuring out what the fuck is going on with Atom. And like I told you, I made a specific video around that. Atom can't be read technically now because the technicals are entirely fucked up. Because we have an accumulation pattern which is freakingly bullish as fuck, though you just need to be patient, not trying to figure out the whys and hows, just try to set things easy on you guys. It's a Wyckoff accumulation, that's the sign of further bullishness to come, but it's just diluting the time. It's time dilation. It's really, really, really going to be painful. It's going to raise your impatience biases. It's going to raise your uncertainty biases. You just need to be smart enough not to fall for these biases. Understand that there are multiple variants of this pattern, one of them building a higher lowest point of support, a last point of support, which we currently could be very well building right now. So, if you try now to connect the dots, which I clearly don't want the beginners to do, but if you really want to go off-roads, connecting the dots, here's how to do it. Remember what we stated. We have huge uncertainty regarding the S&P 500. We got the same level of uncertainty actually in cryptocurrencies, in the same reference time frame, 4 hours all along. So you can connect the dots. And if you do this, you would say, yeah, S&P 500 could very well go all-time highs. I can't trade it. We've seen Bitcoin says likely possibility to do as well because the Wyckoff pattern of reaccumulation says normally we're going to go higher, finding some liquidity. Ethereum says maybe we're going to go all-time highs, maybe not. That depends on probably fundamentals. And therefore, just don't try to go down this path. But if you connect those dots with Atom, Atom is in a Wyckoff pattern, which can take 2 different forms. The first one is a lowest point of support, which means this is the lowest ever point you're going to get from now on, and we're going to break this structure afterwards. Or we could go down to a spring, which is a final exhaustion move, which could go down, making new lows, so that means going below 5.5, flushing out all the remaining leverage traders, destroying everything, and then, of course, we're going to have the retest, and we go to the highest part of the range. The outcome is the same for both parties. It's going to be bullish. It's just we might go down to 5.5 beforehand. We might not go there as well. So remember, the point here is don't try to be smarter than the market. Wyckoff accumulation patterns just tells you one thing: you can't figure out the bottom. There's no way for you to find the bottom. The only thing you should figure out is that this is fucking bullish. It's just an accumulation. It's a transfer of wealth from weak hands into stronger hands. When the transfer of capital is terminated, when the liquidity is totally drained off, no matter this is Wyckoff schematic number 1 or number 2 variation, you will have a freaking bullish outcome out of this. And it's going to be a long-term inevitable support, which means when we close out this accumulation and breaking out the $16 of Atom, because remember, there's no certainty anywhere in the market, but if we do this, you can have the freaking biggest confidence ever that will never ever go back down to $5. God knows how high afterwards. It just means a massive bottom will have been built, with money flushing out of dumb hands into smart hands. And you know one thing, smart hands are patient, but if they buy something, that's probably because they see value. So, like I've said, could be full of shit, and there could be no actual Wyckoff pattern at play with Atom. It could just be a full of shit asset. You're not going to know, because you're specifically right now in phase C, which is maximizing uncertainty. So there's no way for you to know, just like I don't. But the thing is that I know we're in a Wyckoff, so I'm not giving a fuck. I'm not trying to figure out what's right, what's wrong. All I'm saying is I think the market will give the answer. Here as well, it's a matter of fundamentals. The fundamental in here will sort out the true from the bad ones. There's a possibility of a spring, and it shouldn't move you anyway. It should just be even seen as an opportunity to eventually take more. Eventually. It could never happen, and we would be building the last point of support, going straight up to the top of the range afterwards. So if you're trying to figure out what Atom is going to do out of what Bitcoin signals are sending and Ethereum signals are sending and what S&P 500 signals are sending, you would figure out that these two probabilities are also the likeliest. They perfectly align with what we said earlier. If we want to go to the lowest points of risk taking to the upside, that's $2,000 for ETH. That's a 30% drop out of what we already done. That could definitely translate into a 50% loss in Atom, which would go somewhat below $5. Make that spring fuck off and destroy all the remaining liquidity of speculative leverage traders, and only by that point, all the money will be in the hands of long-term investors, smart money, patient folks. And the rest is just the time will deliver on the promises. If those investors so fit, the market will go higher and these guys won't sell, which means there's no available supply, there is demand and utility, the market goes up, period. Okay? Option B. We've exhausted the sellers. The S&P 500 fails into its third range boundary. Bitcoin terminates its wake of pattern and goes to the top of the range to break it. Ethereum does whatever it does. If it's really stronger than Bitcoin, it's going to overperform Bitcoin and going to go through its own all-time highs. Option B, we all fuck it all up together and we take a huge drawdown to get into the lowest point of entry, lowest risk point of entry. But this bullish option is Ethereum goes wild. Is it going to overperform Bitcoin or not? Depends on Ethereum fundamentals and adoption. We've said multiple times, week after week, they're just flashing fucking green all over the place. So if Ethereum wants to overperform Bitcoin by a significant margin, it's really willing to do so. It's just, well, are we gonna go all-time highs with Ethereum? That's a likely possibility. If we do so, that's a nearly double in price of Ethereum, where Bitcoin could go all-time high with a marginal increase somewhere around $80. That would be 40%. That means ETH could double the Bitcoin gains. So yes, that's something that could very well happen. And if it happens, oh boy, the altcoins, Atoms and others will perform like crazy. Which altcoins? Try to figure out the answer to this. I've seen many people saying those who have gone higher beforehand are the strongest ones and the most reliable ones to go further overperforming Bitcoin and Ethereum. I would tend to say, what the fuck is supporting this? I've got a massive weekly to monthly third range boundary in here in Solana. What the fuck is that? Since when do you buy at resistance territory? I don't see anything here but risks. Risks to buy, and if it doesn't break through, you're fucked. You're really into buying the highest points, and there are signals supporting this area to be very dangerous. So frankly speaking, I'm not buying into these things, though I don't think the entire crypto market could go higher. This kind of speculative frenzy, bull markets raging stuff like, yeah, it doesn't really matter about fundamentals, let's just go fuck it all up to all-time highs. I think some assets have already priced that in. So what I'm tending to say here is that if we're wrong, and if Bitcoin and ETH are going to lose serious ground and crash out, these guys, they're going back down to 50. And they're not going to lose 30%. They're going to lose 60% out of where they are. So be very cautious with that. I've said it and I'll say it again. The rewards to risk balance is absolutely different, scattered all over the altcoin markets. Some alts have overperformed like fucking crazy, and if the shit hits the fan, these guys will take a massive hit. Like the kind of hit you haven't seen since FTX. The kind of absolute destruction in the market, back to bear market mood, and that's going to be massive liquidations all over the place. That's a possibility, but that's frankly improbable. Because from what we see from the big guys, I don't see anything but bearish exhaustion. So the end of it is just, I think we're going to go higher out of this, not because the market is strong, just because the bears are weak. And if that's what happens, going all-time highs, and we'll see the fundamentals speaking project by project. It's not a whole market going higher or whatever. Some assets will not go all-time highs, and I sincerely doubt that those who've gone faster and stronger are the ones that are going to go faster and stronger ahead. I think those have burnt most of the gas they had in the tank. They're probably going to keep on ranging. That's the reason why I warned you significantly about the over-speculative asset, the injective, the Solanas, the whatever the fuck are lining up crazy gains for the past 6 months. Be very cautious with them. These guys, I think, the best they can do is get to a third range boundary where, frankly speaking, you should get the fuck out of. That's all I'm saying. That being said, I'm going to leave you guys with that. That's all there is. If you want to go off-road, try to do it well, okay? But don't try to connect all the dots, like if this happens there, then this and that and that and that and that in all the market and whatever. No, it's not what it is. The different situations we foresee in here, meaning that some assets that are supposedly correlated are not, to me, because they offer and propose significantly different type of strategies and risk limitations. Some have Wyckoff accumulation, some have Wyckoff reaccumulation. So it's a mess. So if you're trying to think the crypto market as a whole, like you can buy it all or sell it all, I think you have it absolutely wrong. Because if you look below the surface, you will see totally different situations and technical situations all over the place. So I think there's one thing I could definitely say for sure, is that there's no one crypto market anymore. There are lots of markets, there are speculative, very dangerous assets which have taken most of the gains already and could only suffer massive losses if they end up being proven wrong. The best they can do is stay there. And I think that's the case for the Solana injective and the like. They all have over bullish technical structure and they've exploited all of the upside potential so far. Now the best they can do is stay there. They look more like ranges to me than markets that would go all-time highs. They all have hit significant third-range boundary resistances. Some are even trading in all-time highs with no significant adoption metrics. That I've warned you about, like the injectives and the like. There's no sign of true adoption. It's all faked out. All the numbers are really, really, really questionable. So be very cautious with that. All right? For the rest of the market, the actual bunker stuff that hasn't performed so far, the AVEs, the DYDX and the like, they all flash either Wyckoff accumulation pattern for more than a couple of years, or they are ranging silently, waiting for fundamentals to kick off. The wait for them to deliver or not, don't try to time the market.